welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Coaches always say, we'll take it one game at a time, which is reassuring, since playing multiple games simultaneously seems inefficient. Synergy, what two mediocre ideas create when trapped in a PowerPoint together. Networking, talking to strangers in business clothes while pretending you're not desperate. Pivot, corporate for, we were wrong, but with enthusiasm. Vision statement, aspirations written by people who haven't checked the budget.
The last time the Fed cut interest rates, with inflation above 3%, was in October 2008. The economy was collapsing, the banks were imploding, and S&P 500 looked like a ski slope. Fast forward to today. Inflation is still over 3%, unemployment is a calm 4.3%, and the stock market is throwing a rooftop party. So why is the Fed easing? Because this cycle makes no sense. Fed is cutting rates not out of crisis, but out of vibes. Inflation is sticky, growth resilient, and policymakers are apparently preemptive, which is economists speak for, please don't blame us later. India has quietly muscled its way into the world's top 4 IPO markets, raising nearly $16 billion this year, right behind China and Hong Kong, but miles ahead of Japan. Not bad for a market where half the investors still ask, what is the issue price again? The surge says a lot about sentiment. Domestic liquidity is strong, global investors want some exposure, and every second startup believes it's the next HDFC Bank. Meanwhile, China's IPO engine is slowing, Hong Kong's trying to stay relevant, and the US is still the big league everyone watches. The dollar's not dead. Remember all those forecasts last year about the dollar's imminent collapse? Turns out the apocalypse was oversold. The trade-weighted dollar dipped a bit, flexed, and then quietly reminded everyone that it's still the best bad option in global finance. Why? Because there is no alternative, or as the markets lovingly call it, TINA. The euro's still busy negotiating with itself, Japan's too polite to raise rates, and China's currency is about as free as a state-owned enterprise. For all its flaws, debt, deficits, and political melodrama, the US dollar remains the world's, in case of emergency, break-glass currency. India is inching into the so-called influence trigger zone, that magical stage where per capita income crosses $5,000 and consumer behavior shifts from survival to self-expression. Translation, fewer price tags, more lifestyle choices. By 2035, nearly 1 in 4 Indian families will be upper middle class. A polite way of saying Instagram's next target market. Spending on essentials has fallen sharply since the 1950s, while discretionary spending on sneakers, skincare, and premium tea has tripled. Premium categories are growing 2 to 3 times faster than the global market. The bar of soap is losing to body wash, instant coffee is fighting cold brew, and detergent ads now talk about fabric care like it's therapy. India's foreign investment numbers just took a power nap. Outward investments dipped to $10 billion in Q2 FY26, almost half of last year's levels, while net FDI into India actually turned negative in August at minus $0.6 billion. Blame it on a global slowdown, fewer big ticket deals, and investors who have suddenly discovered the joys of wait and watch. With both inflows and outflows softening, the FDI dashboard looks less like a boom and more like a layover. The good news? It's not a panic. Just pause. But for a country chasing growth headlines, that pause feels unusually quiet. India's shrimp industry, once a quiet hero of export earnings, is suddenly feeling like the catch of the day for all wrong reasons. US tariffs have pinched margins, and replacing the demand isn't as easy as switching pawns. Analysts say exports can only pivot to other countries, or at worst rely on import substitution, and not domestic buyers. After all, India eats its shrimp modestly and exports its ambition. If FY25 had a slogan for India Incorporated, it would be Mind the Gap. CEO pay surged again, the median remuneration for Nifty 500 directors rose over 16%, outpacing even the strong profit growth. Meanwhile, the 10 crore club has quietly doubled in just 7 years. At the top sits Sandeep Kalra of Persistent Systems, earning nearly 150 crores per annum, about 880 times his median employee's pay. Others aren't far behind, from tech to auto to pharma. It's not just a pay raise, it's a reflection of who's capturing India's corporate upside. After years of letting the government do the heavy lifting, India's private sector seems to have dusted off its wallet. In the first half of FY26, new private investments surged 41% to 24 trillion rupees, led by manufacturing, energy, and a welcome dose of optimism. Foreign investors too have rediscovered enthusiasm, with projects valuing project values up 130% year on year. Meanwhile, public sector plans slowed slightly, a rare moment where the private sector actually outpaced the government. For years, India's growth story was built on fiscal muscle. Now it's getting a corporate core workout.